Good morning and welcome to this Wednesday, April 27th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, earnings are starting to come in. Got a couple of big ones last night. We're going to talk a little bit about that, but Microsoft and Alphabet, Google, both reported last night. Got them heading in different directions this morning. Before we get into any of that, though, and before we get into yesterday's action, I will take you over to Earnings Beats for those of you that are new to Earnings Beats. All you have to do is scroll down, go over to earningsbeats.com, scroll down. We have a free newsletter. Love to have you join our community. In addition to getting a newsletter 3 times a week, anyone signed up for our Earnings Beats Digest will get room instructions when we have free events. And we do have plenty of those throughout the year. So just go to earningsbeats.com, sign up with your name, email address, hit that subscribe button. The newsletter articles that come out are very easy reads, very quick reads, usually just a couple paragraphs and a chart showing many of the things that we like to feature: relative strength, earnings, gaps, candlesticks, trend lines, moving averages, those types of things. I think you'll find it very informative and educational. And potentially, they could set up some nice trading opportunities for you. But of course, that's up to you. All right. And oh, by the way, we do have an event coming up later today at 4:30. That's certainly worth mentioning. Q1 earnings. We have a very, very unique way of looking at earnings reports or, the anticipation of earnings reports, going through and looking at some relative strength of a lot of companies that will be reporting here over the next, tonight we'll be looking at companies that will be reporting probably over the next week to 10 days or so. And I can tell you that probably covers 1,500 companies. So it's going to be a lot of companies, a lot of charts that we'll be looking at later this evening. This is a members only event. So if you would like to join, you can click and get a free 30-day trial. That's all it'll take to get into the event. And we got a lot of other things coming up in that 30-day period, including our draft of our portfolios next month, May 19th. So a lot of good stuff that you can check out during your trial if you so desire. All right, let's take a look at what happened yesterday. I can tell you one thing, it was not pretty. Dow Jones Industrial Average down 809 points. The S&P 500 down 121. The NASDAQ down 514 points yesterday. And that is not a misprint. You can see we closed below 12.5. We actually took out the February and March double bottom, barely. Futures are pointing a little bit higher this morning, but I'll tell you, we did not finish well. And money's just not been rotating the right way to be, trying to call a bottom. I'm not saying the market can't bottom. I'm just saying we're not getting any signals of it. And so I think you have to remain very cautious here. Mid caps were down 75, small caps down 38. So on a relative basis, the NASDAQ again hit the hardest, down almost 4% on the day yesterday. And since the end of March, remember that rally that we had? We got over 14.5. Yeah, that seems like eons ago at this point. We're down 2,000 points on the NASDAQ in less than a month, or right about a month. That's been kind of crazy. It's been almost 15% in a month on the NASDAQ. So if you're keeping track, that's not pretty. It doesn't happen very often to see that kind of a pullback in that short a period of time. Looking at the individual sectors, I will mention energy was a group that was higher yesterday. I don't have them up on the chart. It was just fractional. But I wanted to point out the 5 groups that led this move to the downside. All 5 aggressive groups: discretionary, technology, communication services, financials, industrials, all down at least 2%. And you can see communication services down more than 3%, technology close to 3.75%, and discretionary down more than 5%. Automobiles got hit hard. Tesla took a big hit yesterday, and that was one of the big reasons why we saw the discretionary stocks do so poorly. Amazon and Tesla, the 2 highest weighted stocks in the XLY, and they were both down fairly substantially yesterday. So not a good day for any of the growth areas of the market. And again, that really weighed on the NASDAQ. 10-year Treasury yield currently, and the thing is, we're actually getting a little bit of a pullback here in the yield. Market doesn't seem to care about that right now. 2.75% this morning. We're down about 2.5 basis points. Still, we're in this uptrend, which has been pretty healthy. Kind of a big deal here over the last 7 or 8 weeks, rising from 170 even to this recent pullback 275. We weren't far from 3 just a few trading days ago. Last week, middle of last week, up near 3%. I still think we have a chance of going back up there again. The Fed is likely to raise 50 basis points when they meet next week, and it's not going to be pretty, I don't think. Now, we could get into a whole different discussion on what I think the Fed should be doing, but what I think and what they're going to do probably are 2 different things. So we have to deal with what they're going to do. And they've been talking about 50 basis point hike. They try to be transparent. So I would assume we are going to see a 50 basis point hike next week. And I think the market's already preparing for it. I think that's why the market is selling off, probably on the news. Whereas we approach the news, at some point, we're going to get a nice rally. But is it going to happen today or tomorrow? That's a really tough question to answer. I mean, when the VIX gets up to the level where it is right now, let me just pull up the VIX. The VIX shot up yesterday another 24%, 6.5 points to 33.52. When you get the VIX rising like this and into the 30s, nothing you see will probably make sense. You're going to see craziness in both directions. And if you can time it, congratulations, you'll make a lot of money. If you can time the ups and downs and the reversals, but if you can't and you're trying to trade and you're chasing every move in this market, you can lose a fortune very quickly. So, I don't know how popular this is, but for me, when the VIX gets up in the 30s, I sit it out. I do not trade. I am sitting right now 100% cash. I've traded the QID a little bit, but I'm completely out of that. I don't know. When we get to 33, you saw how quickly the S&P 500 rallied when we got up to that 37, 38 level. The VIX doesn't have to get to 37, 38. It could go through it. We could top at, the market could bottom. The S&P 500 could bottom with a VIX at 33, 34. It could bottom when we get to 38. It might wait until we get to 45 or 50. I don't think we're going to see the 2009 level, or maybe it was 2008 when the VIX shot up to 90. I don't think we're going to see that. Same thing with the pandemic. I don't think there's that kind of fear in the market. And I don't think there should be that kind of fear in the market. But these intermediate term lows generally form when the VIX gets up into the mid upper 30s or even into the 40s. And we have seen intraday moves even into the 50s. And the problem is, if you get in when the VIX is at 34, if you're off a little and the VIX ends up going to 44, those 10 extra points could mean 10% on the S&P 500. When the VIX is up here and rising, this is when we have the biggest drops. That's why you saw the NASDAQ down more than 4% yesterday. That's why discretionary stocks were down more than 5% yesterday. The volatility index, when it rises, the market, it goes through a period of indiscriminate selling. I call it impulsive selling. So it's not rational. You can look at technical analysis and look at price support if you want, but a lot of times when the VIX is like this, it goes right through support without even blinking an eye. So be really careful out there right now. The volatility index is screaming at us that we could see anything, literally anything. We could see, you might think the market, well, it sold off so much yesterday, it has to bounce today. Well, we could be down another 5%. Or we could bounce 5%. And I don't know which one it's going to be. And so for me, putting my money to work, I might as well flip a coin. And if I lose, I throw my money out the window. No, thank you. I'm going to sit down, sit back, relax, watch what's going on, study the market, look at the earnings tonight, do a lot of those things, but I'm not going to try to catch the exact movements in the market. It's just too difficult. All right. So one of the things we talked about back at the beginning of the year, I want to talk a little bit about sentiment. I want to talk about the equity only put call ratio. So this was back in the beginning of January. If I pull this chart up, let me change the date for you here. Instead of going through today, I'm going to go back and show you what this looked like when we did Market Vision 2022. So, all right, that's not, oh, it changed my start date. Changed a lot of things here. Now, let's go back in here and see this now for a second. Let me get this back up on the screen. Sorry about this. Okay. Let's just forget about it. I don't know why it changed it on me, but back here on January 8th, this 253-day moving average of the equity only put call ratio was just starting to turn higher. And the significance there was, number one, I was already bearish about the market coming into the year. There were a number of signals. We had a lot of money rotating into defensive groups to open up the year. And the stock market, look at this. Let me just annotate this, change the annotation here. This move right here from the bottom to the top was almost 120% in less than 2 years. If you go back the last 20 years, there is no other period anywhere like this. I mean, here we went up 101% over 2 years. That was pretty strong. 56% over a couple of years, 47% over a couple of years. 117% was unmatched. Now, we were coming off the panic low. So, you know, you're going to get a quick rally when you finally bottom like that. So that was part of it. But even after we came back up following the pandemic, we kept rising and rising and rising until we finally put in this bottom on the 1 year moving average of the equity only put call ratio. And what that tells me is that we just got so complacent. Everybody in the market felt like we couldn't go any lower. So everybody was buying equity calls relative to puts. I mean, this isn't my opinion. This is fact. Look at where we are or where we were. We were down at 0.46 or 0.455 was the 1 year average. If you look back in history, the lowest we ever got on these other, you know, during other periods of strength in the market, here we got down to 0.59, here's 0.58, here's 0.575. This move took us down here to 0.455 or 0.46, an unbelievably low level of the CPCE. And if I take a look here, now this is a daily chart of the CPCE. Now, if we looked back at that move, the 1 year moving average, we were at 0.46. And then you come forward and you look at the daily readings. Look at all these daily readings for the last 2 years and look how much lower they were than at any other period in the last, 9 years, really since the secular bull market began. And I treat the secular bull market having begun as of April 2013, because that's when the S&P cleared the 2000 and 2007 highs. So for me, that's when it was confirmed. A lot of people will say it's 2009. That's fine. And if you knew in 2009 that there was a secular bull market, yeah, you could have done great. But back then it wasn't easy to see. 2013 is pretty easy to see. We got the breakout. Anyhow, over that 2 year stretch when the market just kept going up, 116, 117%, everybody was playing calls. And one thing I said back in Market Vision 2022, back on January 8th, was we needed sentiment to reset. Sentiment was way too bullish. It's hard to keep going higher when everybody believes the market can go higher because they're all in. So coming into the year, that was the big problem. And so what I was looking for was for this 253-day moving average to start moving up. And when it moves up, if you look at any of these other periods, when you start getting more bearish, why do you get more bearish? Well, you get more bearish because the market comes down. So during these periods of rising equity only put call ratio, notice throughout the entire period, the market goes either down or sideways. 2006 to 2009, this whole period, we went up for a little bit, came back down. By the time we peaked on this 1 year equity only put call ratio, we were all the way down 50% from where we were when this started. In 2011, 2012, during this period, the S&P 500, it looks like maybe was down 4%. Here, 2014 through 2016, we were basically flat. Then we got really choppy with the trade war and with the pandemic. It was just a lot of ups and downs. So I kind of ignore all of this, but if you did actually go in and look at these little moves to the upside and downside, you'd see that the pattern still remained. And then here, as we're moving up, look what's happening. The market's weakening. So this was one of the things, one of the keys that we talked about back on January 8th as we looked out over 2022. And what I was expecting then and what I continue to expect is that our sentiment is going to reset. People are going to start getting more bearish because the market's not performing well. And just when the market bottoms is going to be the time when everybody is at their most bearish. They're going to say this market will never go back up again. It's, inflation, interest rates going crazy, debt, you pick recession, just pick something. The market will, market's down, and that's when everybody gets bearish and thinks, oh, I better get out. The time to get out was January. I mean, if I'm in now, if I've been holding for the last 3 months, we might go lower, but I believe the overall market goes higher later this year and into next year. I think we're going to be back at all-time highs. So if I've held till now, I'm holding, because it would be my luck to get out now and put in another triple bottom or false breakdown and the market would take off. So if I'm somebody who's been sitting in and riding this market to the downside, personally for me, I think it would be very difficult to get out and then get back in when the market goes higher. It's just psychologically very difficult to do. So I just think if you've been riding it for 3 months, I would keep riding it. That's just my opinion. Obviously, you have to do what you have to do, and it's your call. But I do think that, we're well on our way to establishing a bottom. Whether or not we're there or how much further we go is hard to say. I do, I said back in January, I thought the S&P could hit 3,800. That would be the 20% for a bear market, what most people call a bear market. I think we're already in one. You can call it whatever you want. If you look at some of these stocks that have been absolutely bludgeoned, look at the semiconductors, look at the banks, look at the transports, look at pretty much anything. We've gone down quite a bit. So a few handful of large cap growth stocks have held the S&P 500 up. And even though they're starting to fall, we've seen some rotation into energy and some other areas that have kind of lessened the blow. So the S&P is only down like 14 or 15%. If you want to say, hey, we're still in the bull market rally, that's fine. Go ahead. I think we are in a cyclical bear market, which I believe will end in the next, could be the next few weeks, could be the next few months. But if we're still down over the summer, I believe fourth quarter, we are going to rally big. Just my opinion. You can agree, disagree. That's fine. That's what makes a market. But I do think we are getting this reset that I had talked about. Market is now beginning to grow more bearish. And if you look at the S&P 500 here, this is a 10-year chart, or maybe it's a nine-year chart. It's a daily chart. But the reason I wanted to show you this on a daily chart is that I wanted you to look at the daily, well, this is a 5-day moving average of the equity only put call ratio. And right now we're at the highest level that we've seen in 2 years since the market bottomed and we started coming back up. We are finally starting to see this reset. You see the higher highs and higher lows coming in. If you go back and you look, 2013, 2014, we were really bullish. We got down to about a 0.50 or a little bit below 0.50 on the 5-day. And you see the higher high, higher low, higher high, higher low. And it was all of this consolidation and selling that got us all the way back up here. We reset. And then once we got to this point and everybody started to buy puts, we were ready to launch again. That's what we're doing right now. We're working our way back up to a point where we can launch again. We're not there yet. I don't think we're there yet. So still got to be a little patient. Again, if I hadn't already made moves to be in cash, I'd probably just stick with what I got, just ride it out for the most part. I mean, obviously there could be some stocks that are just really are no longer, valid. I mean, you probably look at weekly charts and get a sense of that. I mean, stocks like, Netflix, 700 to 200, just completely beaten up. It'll probably come back, but I'd need to see some strength in Netflix. I don't want to keep riding that one to the downside. Anyway, yeah, so when I look at this chart, I'm expecting that we could get this move all the way back up to 0.55, maybe 0.575. I don't think we're going to see anything up here. We were very, very bearish back. This was a 2-year secular, well, really it was a 9-year secular bear market that had been wearing on us. The dot-com bubble, the financial crisis, that had sentiment really bearish. So we're on the upper end of the scale. Even 2011, 2012, we were still feeling the effects from the financial crisis, quantitative easing, the banks, trying to make sure the banks were still or were stable. Say, 2014, 2015, we really still were too close to the 2009 financial crisis. But after multiple years of going up, and especially after the last 2 years, you can see we got the sentiment swung completely to the other side. And so this is what we're working off right now. All right, let's talk a little bit about earnings because we do have a big event coming up later today. What we do, if you're not familiar, this is just one day of earnings. I just wanted to show you. This is May 4th so it's going to be next week. What's May 4th? I think that's Wednesday next week. Yeah, Wednesday. And so what we do is we have every stock that reports next Wednesday that has a market cap over $1 billion. And also over the last 3 or 4 months has averaged trading at least 200,000 shares a day. So we want liquidity and we want size. And then all we do is we put every one of those charts. And if we edit, I can tell you how many there are on here. 213 companies just next Thursday. And we have a chart list that shows you how each one of these stocks are trading relative to their peer group. So this doesn't tell me that ABC is going up. This tells me ABC is going up versus its medical supply peers. And what you can do with this relative strength chart list is you can hit this view all. You can come in, hit summary, and then you can look like yesterday, Race, which is Ferrari, outperformed its industry group, automobiles, at a percentage that was higher than any other stock on this chart list that outperformed its group. Now, partly you can see the automobiles, part of this is because Tesla had such a horrible day that if any of these other stocks just went down a little bit, because Tesla heavily influences the automobile index, that's why those two were up. But what I find interesting going into earnings is how are these stocks performing relative to their peer group over, say, the last month? And that'll give you a little different view. So SIMO is 52%, is outperformed its semiconductor peers by 52%. And it's getting ready to report earnings. Now, semiconductors have been really weak. So some of these are in areas where, you can see semiconductors been weak, internet's been weak, software, specialty retail, but some of these are stronger than their peers and they're in good groups, exploration and production. So this is an energy group, and TALO has been outperforming the energy group by 16 percentage points over the last month. So you got a strong group, and at least for the last month, you got a leader. So I'd pull this chart up, and I can see we bottomed at the end of January, and we've had a pretty strong run. And actually, it looks to me like a little bit of a relative cup. Uptrend, cup, handle. With earnings, maybe we get a big breakout here. This would be an interesting one to take a look at. So I could even pull up the chart at this point and say, well, let me see what that chart looks like. Well, it's just recently broken out. It's pulled back, put in a nice little hollow candle there near the 20-day. This one's one coming up on earnings that I think looks pretty good. The AD line's been strengthening. Looks like it's been under accumulation. This pullback could be quite an opportunity on TALO. And all of that stems from going back and looking at this relative strength chart list. Now, just as you can look at the top performers, and by the way, I could go back 3 months and see how they're doing the entire quarter, and you'll see a different group leading. Well, there's TALO, up 55% over the last 3 months. So it's third on this list of more than 200 companies. Also, before I show you the weak ones, look at GoDaddy. GoDaddy in the internet space, outperforming internet. Of course, internet's been horrible. So if we pull this up, you can see here's the relative chart. It looks absolutely great, but you need to look at the absolute chart, not just the relative chart. And here you can see it's trying to break to a 52-week high. And you might say, well, wow, that's showing a relative strength. Well, if we pull up a relative chart, one thing you'll see is look at the internet group. We were at 3,900. Now we're at 2,600. So while this has been going down, GoDaddy's been going up. So GoDaddy's showing tremendous relative strength versus its peers. Are we going to find out something big with earnings coming up? Next Wednesday, we're going to find out. I would feel much better about the stock with its relative strength going up than I would if it was going down. That much I can tell you for sure. But then if you click on this percentage change, you can get the ones that have been the worst performers. And these are ones probably I wouldn't be expecting a whole lot out of, especially if it's a weak stock in a weak group. Look at AMPL versus software. So look at the relative weakness, been absolutely horrible. And again, we pull up the absolute chart on AMPL. It's in a bear flag. This chart looks to me a lot like Netflix when Netflix reported. Look at Netflix. See how it had gone down, big gap down. It was kind of consolidating here for a while, and then boom, another big gap down. You look at AMPL going down, then big gap down, then sideways consolidation. Looks like a bear flag. I mean, with this underperformance, I wouldn't be surprised to see another big gap down on AMPL. So what we're going to be doing later today, this is just one day and just looking at a few charts off this one day, 200 charts. Well, I've gone through and I've looked at probably 1,500 charts between now and the end of next week. And there are going to be a ton of companies reporting, and I'm going to give you my thoughts on which ones I think are coming out with some good news, which ones are not going to come out with some good news. And by the way, last week we did a sneak preview, and I gave 7 of my top stocks that I really liked going into earnings last week, and I gave 9 that I didn't like. The 7, actually, I'll just give you the numbers. I'm going to go over the numbers at the event tonight, but let me just show or go over this with you. So the average gap open of the 7 stocks that look good to me, they averaged gapping higher by 4.4%. And that was not in a good market, by the way. The market was not good. And there were 9 stocks that I gave that I thought looked really bad heading into earnings, and they averaged gapping down 3.28%. So the difference between the good stocks and the bad stocks, the difference in their gaps after earnings were reported were almost 8 percentage points on average. So I think relative strength is huge. So if you're a member at Earnings Beats, you can come to the event tonight. And if you're a member of Stock Charts, we'll actually have these chart lists available for you to download. and put right into your account. So I think that's pretty cool. All right, it's 9:30. Actually, I wrote an article yesterday. I talked a little bit about these earnings. Here was Nucor, looked really good to me going into earnings. This was the day it reported earnings. It actually went up 10% intraday with earnings. Now it's come back down. We've seen some profit taking, but that was a big run after earnings. Let's go ahead and take a look at a couple of companies that reported. I want to do this fairly quickly. Let's look at Microsoft. Since the market opened, we'll get a quick look at where they are. Microsoft's up about 4.5%, up $12. Microsoft beat on the bottom line. Microsoft came in 222 versus 218. Then we had Google, which was kind of on the other side. You can see Google right now is down $95, down 4%. They missed. They were expected to come up with earnings of $25.70. They came in at $24.62. Not very good action. Visa, big gap up. They beat $1.79 versus $1.65, so they're up 9%. Nice action there. Then you got Texas Instruments, which is down 3.6%. They beat 235 versus 217, but market not treating them very nicely. Let's see a couple of others that were pre-market not doing very well. Let's pull up F5. There you can see it down 12%, $24. By the way, it fell down. I see again downtrend followed by sideways consolidation, kind of a bear flag. And there's your breakdown after earnings. Stock did beat 213 versus 201, but I didn't see guidance. Maybe they warned. Juniper missed by a penny, 31 versus 32 cents. You can see the market not liking that, down 4.6%. A couple of others. Boeing this morning had a big miss. Boeing still can't get things going, down another 5% or $8 today. And it just keeps trending lower and lower and lower. Not good. You look at the relative strength versus the aerospace group. It was at a 52-week low. The market is screaming at us, stay away from Boeing. I mean, it probably would be a great company to accumulate for down the road. But if you're a trader, you're just wasting capital as long as this company continues to trend lower. Garmin missed 111 versus 115. Stock only down 1%, though. That could be a good sign. Let's see, other good ones. General Dynamics beat 12 cents. They were up pre-market. You can see them up about 2% here. T-Mobile, I'll give you one more and then we'll wrap up for earnings. T-Mobile beat 57 cents versus 41 cents. Stock right now up about 3%. And let's move on to the three you must see and then we'll wrap up. The first one I wanted to give you was Occidental Petroleum. And what I'm doing here is I went back over the S&P 500 and I pulled up the best performer year to date in the S&P 500, and this was it. Occidental Petroleum. I think it's pulled back to the 50-day, and I think this is a key area of support. I think if it goes much below about 52, I'd be out, but this is one that I would look maybe to return back up to 62.5. So I think this one actually looks pretty good. It has been the best performer, but over the last month, you can see we have seen some pullback, a little bit of weakness here. All right, the stock in the S&P 500 that has done the best over the last month, Twitter. Of course, it's been in the news quite a bit because of Elon Musk and Tesla buying the stock, but it is subject to Tesla getting financing. I think Tesla has to pay Twitter $1 billion if they're not able to secure their financing for the acquisition. So I think there may be still a little bit of a question, but Twitter, I think the number came in at like 44 billion. I don't know exactly what the number was, but that was what the deal was for. Twitter, though, has been downtrending on its AD line for a while. I mean, I like it more toward the lower end of this range and probably sell it toward the upper end. I mean, this would be more of a trading vehicle for me. And then the last chart I have for you is the best performer in the S&P 500 over the last week heading into today. And that belongs to Kimberly-Clark, which is a defensive stock, which came out with earnings, nice earnings, gapped up. It's trying to get through 144, hasn't been able to just yet. I would buy it on a breakout if you start seeing it trade 144, 145 and the volume's there, I would be a buyer. To the downside, I think, if the market's weak, this has been a good performer, but I wouldn't be surprised if it moved into this gap zone, maybe down to the 20-day. So if I wasn't already in it, I probably wouldn't be in it. I'd either wait for maybe a little bit more weakness or wait for that breakout. All right, that's it for me. Let's see if the market is rebounding. It was in pre-market. Yeah, we're getting a nice little pop. NASDAQ up 0.75%. S&P up about 0.4, almost a half of 1%. Dow up just a little more than 1/3 of 1%. Small caps, mid caps, both up. Not very much though. The VIX is down a couple points, back to 31.31. So that's down about 6.5%. But just remember, this is morning time. We know what can happen. The morning strength, we can see that carpet pulled right out from under us. Is this a rebound? Is it a morning head fake? VIX in the 30s, flip a coin. I don't know. I don't know which way the market's going to go. So the best protection that I see is simply to be in cash. So as a trader, some traders love this volatility, absolutely love the huge moves. And I understand it. I mean, you can make a lot more money, but you can also lose a lot of money very quickly. And that's the part. As a trader, I want to try to manage my risk. And I don't know how you do that in this market, especially if you're holding overnight, because we could wake up to Dow down 1,000 or Dow up 1,000. I don't know what's going to happen. So anyhow, be careful out there. I'll be back tomorrow morning. You can get me over at Stock Charts TV at 9 a.m. for the next episode of Trading Places Live. Again, tonight we have a great event coming up. Go over to Earnings Beats, and right here on the homepage, you'll get a little description. You can click and sign up for a 30-day trial. We'd love to have you for tonight's event. Everybody have a great day. Take care. Happy trading.